How small apartment investors can diversify across asset classes. Analyze the current portfolio. Assess current allocations to real estate and determine over-reliance on any single asset type. Evaluate exposure to market risks, such as local real estate trends or interest rate changes. Incorporate diverse asset classes. Equities. Invest in REITs or real estate-focused stocks to gain exposure to broader markets. Fixed income. Add municipal bonds or mortgage-backed securities for income stability and lower risk. Commodities. Allocate a small percentage to gold or energy assets for inflation protection. Alternative investments. Explore private equity or crowdfunding platforms for access to niche real estate opportunities. Utilize investment vehicles, ETFs, and mutual funds. Use diversified funds to gain exposure to multiple asset classes with low cost and ease of management. Real estate syndications. Partner with other investors to participate in diverse property types or markets. Direct ownership. Combine small apartment holdings with other asset types like single-family rentals or commercial properties. Balance risk and return. Use risk tolerance and investment horizon to determine the appropriate allocation to each asset class. Rebalance periodically to maintain desired allocation percentages and adapt to market conditions. Example: comparing a diversified portfolio with a concentrated portfolio scenario. Portfolio A, concentrated, 100% invested in small apartment properties. Portfolio B, diversified, allocates 40% to real estate, 30% to equities, 20% to fixed income, and 10% to commodities. Performance during a market downturn. Portfolio A, suffering from local rental market challenges such as declining rents or increased vacancies, results in a 15% decline in portfolio value. Portfolio B, real estate declines by 15%, but equities and commodities increase due to recovery in the broader market, and fixed income remains stable. Overall portfolio decline is limited to 5%, providing better resilience and recovery potential. Insights. Portfolio stability. Diversification reduces the overall impact of adverse conditions in one asset class. Risk-adjusted returns. Balanced exposure enhances long-term performance relative to risk. Benefits of asset class diversification for small apartment investors. Reduced portfolio volatility. Balances gains and losses across different asset classes, ensuring more stable returns. Improved resilience. Protects against market-specific risks, such as a real estate downturn or rising interest rates. Enhanced opportunities. Provides access to growth in markets or asset classes that may outperform real estate in certain conditions. Long-term wealth creation. Combines growth-oriented and income-generating assets for sustained portfolio growth. Summary. Diversifying across asset classes is a critical strategy for small apartment investors to achieve portfolio stability and manage risk effectively. By incorporating equities, fixed income, real estate, commodities, and alternative investments, investors can create a balanced portfolio with improved risk-return characteristics. This diversification not only mitigates correlation risk but also enhances long-term growth and resilience, ensuring sustainable investment success.